Welcome to Module 4, FICC Derivatives of the ACI Dealing Certificate. In this module, we will cover a wide range of derivative instruments used in fixed income, currency, and commodity markets. We'll begin with the concepts and definitions of derivatives and their role in financial markets. We'll discuss their objectives, advantages, and the risks that come with their usage. From there we'll move into currency options, exploring their terminology, how they differ from other FX derivatives, and how dealers and corporates use them to hedge against currency risk. We'll analyze the functions of calls and puts, and see how they can be combined into strategies such as spreads, straddles, strangles, and risk reversals. We'll then discuss the technical elements of options, such as strike price, premium, expiry, and exercise type, and compare over-the-counter or OTC contracts versus exchange-traded contracts, including premium settlement conventions. We'll also practice calculating the payout profiles of long and short option positions. Thereafter, understanding the options, we will move to understand and discuss interest rate derivatives, beginning with forward rate agreements or FRAs, interest rate swaps, basis swaps, and money market futures. We'll learn how each of these instruments can be used to hedge interest rate exposure, and how settlement works against benchmark indices. We'll also cover the mechanics and collateral procedures of exchange-traded futures, and the role of the clearinghouse. We'll also understand the basics of overnight index swaps, OIS, across the main benchmarks, Euro-STR, SOFR, SONIA, SARN, and TORNA, and then turn to interest rate options, including caps, floors, collars, and swaptions. Finally, we'll understand the Greeks, delta, gamma, vega, theta, and rho, with practical applications of delta hedging. We'll wrap up with the concept of mark-to-market and its importance in daily risk management. By the end of this module, you will be equipped to not only understand the concepts of fixed income, currency, and commodities FICC derivatives, but also apply them effectively for hedging, trading, and risk management. Let's start with the basic concepts and product definitions of derivatives. A derivative is a financial contract whose value is derived from the performance of an underlying asset or benchmark. This underlying could be a stock, a bond, a currency, an interest rate, a commodity, or even an index. There are four major types of derivatives. Forward contracts. These are tailor-made agreements between two parties to buy or sell an asset in the future at a price fixed today. They are traded over the counter, meaning they are customized but also carry counterparty risk. Futures contracts. These are similar to forwards, but standardized and traded on an exchange. The exchange guarantees performance through a clearinghouse, reducing counterparty risk. Options. Options give the buyer the right, but not the obligation to buy or sell the underlying at a set price on or before a specified date. These can be traded both OTC and on exchanges, giving flexibility. However, the seller of the option contract has obligation to honor the contract if the buyer opts to execute the contract. Swaps. Swaps are agreements between two parties to exchange streams of cash flows, typically linked to interest rates or currencies. For example, in an interest rate swap, a party may exchange fixed interest payments for floating interest payments. These are usually traded OTC. In summary, derivatives are versatile instruments that allow us to hedge risks, speculate on price movements, and arbitrage price differences across markets. Continuing with the core concepts of derivatives, let's look and understand some additional definitions. First, the notional value. In swaps and similar contracts, the notional value is the reference amount on which the exchanged cash flows are calculated. Importantly, this amount is not actually exchanged between parties, it's only used to determine payments. For example, in an interest rate swap, the notional might be $100 million, but only the difference in the interest streams is exchanged. Let us now understand the purposes of using the derivatives. Hedging is one of the main uses of derivatives. Businesses, banks, and investors use derivatives to protect themselves from adverse price movements. For example, an airline might hedge jet fuel costs with commodity derivatives, or a bank might hedge its interest rate exposure using interest rate swaps. While hedging is one use, derivatives are also used for speculation. Traders take positions based on their expectations of market movements, seeking profit without owning the underlying asset. This is common in FX options, futures, and equity derivatives. Finally, leverage is a crucial concept. Derivatives often require only a small margin or premium compared to the size of the position. This allows an investor to control a large notional amount with relatively little capital. While leverage can magnify profits, it equally magnifies losses, making risk management essential. The above definitions of the products and concepts, notional value, hedging, speculation, and leverage, forms the foundation of when and how derivatives are used in financial markets. Welcome to the session 2. In this session, we will discuss in details the interest rate derivatives including money market swaps, forward rate agreements or FRA, interest rate swaps, overnight index swaps or OIS, and exchange-traded money market futures. Now let us start by understanding money market swaps, also known as FX swaps. A money market swap is essentially the simultaneous buying and selling of currencies for different maturities. One transaction is for the spot value date, and the other at a forward date. It always involves two currencies, and the main purpose is to manage interest rate risk rather than exchange rate risk. The exposure to exchange rate movement is minimal because both legs are agreed upon simultaneously. Let's understand with an example. Buy €2 million against USD value spot, and sell €2 million against USD value 3 months. Here the euro is funded for 3 months, and the USD is deployed for 3 months. That's why an FX swap is also referred to as a money market swap. We further understand it with following 2 examples below with exchange rates by euro to US dollar for value spot at 1.0950, and sell euro to US dollar value 3 months at 1.0960. This swap represents euro being funded for 3 months while USD being deployed for 3 months. Similarly, selling $5 million against CHF value spot at 0.9135 and buying USD against CHF value 6 months at 0.9075, which represents CHF being funded for 6 months while USD being deployed for 6 months. In short, a money market swap is a useful short-term funding instrument, allowing banks and corporates to manage liquidity and interest rate differentials efficiently. Welcome to our module on interest rate options. Before we move into pricing and strategies, we need a rock-solid grasp of the terminology and mechanics. I'll walk you through each term, explain why it matters, and show short numerical examples so the concepts stick. Definition: an interest rate option (IR option) is a derivative that gives the holder the right, but not the obligation, to enter into an interest rate exposure at a pre-agreed strike rate on or before the option's expiry. The options underlying is an interest rate, for example, 3-month SOFR, 6-month Euribor, or a rate component of a money market instrument, e.g., a bond yield or swap rate. Interest rate options are used to hedge or speculate on future interest rate movements. Now let's unpack the vocabulary and mechanics in detail. 1. Strike rate, exercise rate. The strike rate or the exercise rate is the agreed interest rate in the option contract at which rate the interest can be received or paid if the option is exercised. If you hold a call on an interest rate or a pay fixed option, exercising means you pay the strike rate and receive the market floating rate, helpful when market rates rise above the strike. If you hold a put on an interest rate or a receive fixed option, exercising means you receive the strike rate and pay the floating rate, helpful when market rates fall below the strike. Example, intuition strike equals 2.5% on a 3-month reference. If market 3-month rate at exercise date is at 3%, then a call, pay fixed, is valuable. You pay 2.5% and get 3%, while if market is at 2%, a put, receive fixed, is valuable. 2. Expiration date and exercise style. Expiration date. The date on which the option contract expires is expiration date, and such option contract is not valid after this date. Option has 3 types for its exercise, namely European, American, and Bermudan. These exercise styles mean: European. Option may only be exercised on the expiry date only. Common for many OTC interest rate caps or floors and swaption exercises. American. Option can be exercised any time up to expiry date. Rare for plain IR options, more common with embedded features in structured products. Bermudan. Can be exercised on specified dates, only, for example, quarterly over a 5-year window. This is common for swaptions with multiple exercise windows. 3. Option premium. The premium is the price the option buyer pays to the option seller for the option. It has 2 components, intrinsic value and time value. 4. Call versus put. Terminology in interest rate options often maps to pay/receive fixed across instruments. Call interest rate option gives the right to pay fixed interest rate and receive floating rate. It is used when you're hedging against rising rates. Put interest rate option gives the right to receive fixed interest rate and pay floating rate. It is used when hedging against falling rates. Now that we've covered the basic structure of an interest rate option, let's go deeper into the terminology that traders, dealers, and risk managers use when analyzing and pricing these instruments. These terms, ITM, ATM, OTM, European, American, and the Greeks delta, gamma, theta, vega, are absolutely foundational in understanding how an option behaves and what drives its value. 1. IDM or in the money. An option is said to be in the money when it already has intrinsic value.